Wow, this is absolutely crazy. Okay, let's dive right into this explainer. If you have been watching the financial markets lately, you have absolutely seen the massive, wild fluctuations with Credo Technology Group holding. We are talking about a stock ticker, CRDO. This company has been riding the absolute crest of this massive artificial intelligence wave. Just recently, the stock price hit these incredible dizzying highs of $308.67 per share, right? But then, seemingly out of nowhere, it takes a sharp, violent correction all the way down to the $238 level. The hype is literally everywhere you look. The financial news headlines are screaming about AI data centers, and retail investors are just throwing money at absolutely anything remotely related to artificial intelligence infrastructure. But as focused learners who want to protect our portfolios, we need to know what is actually going on beneath the surface of these massive market swings. We cannot just follow the crowd blindly. Let us strip away all of that market noise immediately. Today, we are examining the cold, hard facts behind the headlines. We are completely bypassing the rampant market speculation to strictly evaluate the underlying fundamentals, the technological moats, and the quantifiable regulatory risks that define Credo Technology's actual valuation. If you look at the data, the true story is always in the numbers, not in the emotional headlines.
Exactly. So, to figure this out rationally, we're looking at 4 specific things today. First, the AI stock hype. Second, a financial fundamentals deep dive. Third, Credo's economic moat. And fourth, 3 future survival scenarios. Let's jump right in. Section 1. The AI stock hype. Let's look at the market momentum versus reality.
The AI stock hype is just out of control right now. Oh my goodness, really. It feels like every single day there's a brand new tech company claiming they are the ultimate backbone of artificial intelligence, and then their stocks just go straight to the moon overnight. People are literally buying first and asking questions later, especially with semiconductor and networking stocks. What is actually happening here with Credo?
Emotional investing during major technological shifts always leads to a massive misallocation of capital. We must disregard the hype completely and look strictly at the market data. It is proven by the numbers that the recent price correction of Credo from the $300 range down to $238 was not a random market fluctuation at all. The data shows this correction is driven by 3 measurable factors that you can see on the screen. First, Credo's exceptional growth momentum is visibly cooling down. While they do maintain a strong rating profile on paper, the explosive, exponential revenue growth rates that the market originally priced into the stock are beginning to moderate. Second, institutional reports have identified potential delays to Credo's upcoming 2027 and 2028 product rollouts. In the highly competitive semiconductor industry, delayed product cycles directly and immediately translate to delayed revenue recognition. Third, there are measurable shifts in global AI infrastructure spending. Hyperscalers, which are the massive cloud computing providers, are aggressively adjusting their capital expenditures. This poses a direct, quantifiable threat to the immediate demand for Credo's hardware. Okay, wait a minute, doctor. Before we get into the heavy math and capital expenditure talk on this, for those of us who do not spend our weekends reading dense semiconductor engineering manuals, what exactly does Credo even do?
Let me break this down for you based strictly on their business model operations. Think of a modern AI data center as a massive, sprawling city of computers. Artificial intelligence training requires massive graphics processing unit clusters, or GPUs. These thousands of GPUs must talk to each other at absolute lightning speeds to function as one single, cohesive computational brain. Credo's active electrical cables, known as AECs, and their optical digital signal processors are quite literally the physical pipes connecting these massive server racks together. Furthermore, their CRDO technology, which stands for serializer/deserializer, takes massive amounts of parallel data, squeezes it down into a single ultra-high-speed serial stream, sends it across the physical pipe, and unpacks it perfectly on the other side. Providing this highly specialized high-speed plumbing is the core objective of their entire business model. So what you just said basically means they aren't actually making the AI brains themselves, they are making the critical nervous system that connects all the brains together so they can actually communicate and function. That is a huge distinction to make.
Section 2. Financial Fundamentals Deep Dive. Let's look at the actual money.
So if they literally make the digital pipes for AI and the AI boom is real, they should be selling these pipes nonstop, right? I have to ask, if they are a massively growing company and literally the hottest sector on planet Earth right now, why on earth is the broader market calling this stock overvalued? Let's look at the actual balance sheet and see what the numbers say. Let us examine the income statement very closely. If you look at the data here, Credo's underlying profitability remains remarkably solid. They officially report an annual revenue of $1.34 billion, paired with a highly robust net income of $472.28 million. Furthermore, their return on equity, or ROE, sits at a staggering 31.6%. To interpret the meaning of this specific number, a 31.6% ROE demonstrates exceptional efficiency by management in generating actual profits directly from shareholders' equity when compared to historical sector averages. However, the critical metric we must analyze to understand the recent price drop is their market capitalization paired with their price-to-earnings ratio. Credo currently holds a massive market cap of $45.65 billion. This results in a trailing price-to-earnings ratio of exactly 97.00x and a forward PER of 49.98x. To interpret the precise mathematical meaning of these numbers, a 97x PER signifies that investors are currently paying $97 today for every single dollar of current net income the company generates. It proves mathematically that the market is already fully pricing in years of flawless, completely uninterrupted future growth. Furthermore, carrying a market cap of $45 billion against a top-line revenue of just $1.3 billion yields a price-to-sales ratio of 34.30x. This indicates an extreme, almost unprecedented valuation premium compared to their traditional semiconductor competitors.
Hold on, wait a minute. What does all of this actually mean for everyday investors with retail stock accounts? They are bringing in almost $500 million in pure net income. That is a mountain of cash by any standard. So why are financial analysts aggressively sounding the alarm bells right now? What do these giant multiples actually mean for us sitting at home looking at our portfolios? It comes down strictly to the massive valuation gap shown here on the screen. A valuation of this incredible magnitude hinges entirely on exactly how fast Credo can grow its revenue year over year and exactly what future earnings multiple the broader market will actually tolerate before selling off. According to market data from Portfolio Pulse, 83.1% of the narrative analysis formally categorizes Credo as overvalued at current levels. The widely followed fair value estimate for Credo stock is exactly $130 per share based on their current cash flow generation. Compare that fundamental data point to the recent trading price of $238 or their recent 52-week high of over $308. This represents a massive, quantifiable valuation gap. To answer your question directly, for retail stock accounts, this means that buying in at $238 exposes the investor to severe, catastrophic downside risk if Credo's growth trajectory decelerates even slightly. The stock price is currently trading on the absolute mathematical assumption of perfection. If there is any shift whatsoever in hyperscaler spending, or if those 2027 and 2028 product rollouts face the exact delays we discussed earlier, the 97x PER multiple will compress violently. This would drive the stock price down rapidly toward that $130 fair value estimate, completely irregardless of the fact that they are still generating positive net income on paper.
Section 3. Credo's Economic Moat. Defending the Business Model.
So, what you just said basically means the market expects them to lay high-speed internet pipes on Mars to actually justify this current stock price. They literally have to be completely perfect, flawlessly executing for years into the future, or the stock drops like a rock. If the expectations are this insanely high, we need to look at what actually protects their underlying business. What makes Credo's technology so unbelievably special that massive competitors can't just swoop in, copy the hardware pipes, and steal their lunch money? Their differentiators lie strictly in their vertical integration and proprietary software-hardware ecosystems. If we look at their operational structure, Credo's most irreplaceable weapon is a platform called Pilot. This stands for Predictive Integrity Link Optimization and Telemetry. In the modern AI data center, networking is the new compute. A single point of failure in connectivity can bring down $1 billion GPU cluster instantly. Pilot serves as the ultimate debug and telemetry platform for these environments. It features an inbuilt logic analyzer, a zero-flap optical dashboard to view live data trends across electrical and optical domains, and LTSM state tracking for their PCIe retimers. Furthermore, their core hardware technology is their uniquely power-efficient 112G SerDes architecture. Their proprietary integrated circuit design provides them with a measurable competitive advantage by delivering equivalent or superior data throughput at significantly lower power consumption rates than their direct competitors. Emphasizing why this matters financially to the business, this system-level approach creates incredibly high switching costs for hyperscalers. Once a massive data center is built utilizing Credo's ACEs and the Pilot telemetry platform, replacing them with a competitor's hardware becomes logistically and economically prohibitive for the customer.
Whoa, wait a minute, doctor. That was a whole lot of acronyms and highly technical jargon. Zero flap optical dashboards? PCI retimers? What does any of that actually have to do with our stock accounts and making an investment decision? That's way too complicated. Could you just give us a simple analogy?
Let me break this down into a much simpler model. Imagine you own a massively profitable, state-of-the-art water park. Credo not only provides the physical water pipes for the giant slides, but they also provide a highly advanced, high-tech control room for the entire park. That control room is the pilot system. This software system detects exactly where a pipe might burst days before it actually happens. Because a burst pipe would shut down your entire water park and cost you millions of dollars in refunded tickets, you will gladly pay a massive premium to use Credo's specific pipes and software ecosystem. Furthermore, once you install their highly specialized control room, you will never switch to a cheaper pipe manufacturer because you would instantly lose your predictive safety net. This dynamic guarantees Credo recurring revenue and incredibly sticky customer relationships, which is exactly what protects long-term shareholder value in the data center sector.
Okay, that makes total sense. They've got the smart pipes, and absolutely nobody wants to risk the entire water park shutting down. That is a huge moat. But look, no investment is ever completely bulletproof, especially in tech. What are the fatal weaknesses here? What could actually break the pipes?
We must examine their official SEC Form 10-K filings to identify the true operational risks to the company. On page 34 of their annual report, Credo explicitly outlines severe regulatory and compliance risks. Specifically, they note the European Union Artificial Intelligence Act, which officially went into effect on August 2, 2024. The 10-K document states verbatim that laws and regulations like the EU AI Act may be burdensome or may entirely prohibit the deployment of generative AI technologies for certain uses. To interpret the exact meaning of this risk for shareholders, Credo's massive 97x PER valuation relies entirely on hyperscalers building more and more AI data centers globally. If global regulations severely restrict how artificial intelligence can be legally used, the commercial viability of generative AI plummets entirely. If hyperscalers cannot monetize AI due to massive regulatory burdens and fines, their capital expenditures will drop immediately. Consequently, demand for Credo's AI infrastructure solutions would evaporate overnight. This would directly impact their top-line revenue and immediately crush the stock's premium valuation.
Furthermore, in the exact same legal filing, Credo officially acknowledges macroeconomic market sentiment as a material risk to their business operations. The SEC filing literally documents that, and I quote directly from the source, many market analysts and other stakeholders have voiced growing concern that the technology sector, including AI, is currently in a stock market bubble characterized by extreme valuations and unsustainable stock price growth. It is incredibly rare and highly significant for a publicly traded corporation to formally write the word bubble into their own risk factors regarding their specific sector. Corporate lawyers generally avoid such inflammatory terms unless the risk is highly tangible. The filing notes that if public perception validates these concerns, it could result in a severe market correction or downturn. This proves by the company's own legal admission that the broader market psychology surrounding artificial intelligence is a tangible operational risk that could drastically diminish their customer base and prevent them from raising future capital. Wow, honestly, that is stunning. The company itself is literally warning its own investors about an AI bubble in its official SEC filings. That is a massive red flag that people really need to pay attention to.
Section 4. 3 future survival scenarios. Let's look at the ultimate forecast.
So, what you just established basically means even the absolute best plumbing breaks if the regulatory water gets shut off completely, or if the entire AI water park goes bankrupt in a massive tech bubble. Given the enormous valuation, the undeniably brilliant technology they've built, and these genuinely terrifying SEC risks, where does this stock actually go from here? Based strictly on the financial data, the projected product rollout timelines, and the regulatory conditions we have systematically reviewed today, we can construct 3 distinct, logical probability models for Credo's future performance. Starting with the bull case, the preconditions, or triggers, for this highly optimistic scenario require completely flawless execution of their 2027 and 2028 product rollouts. This must be combined with hyperscaler data center capital expenditures remaining hyper-aggressive globally. If these specific triggers are met, it financially justifies the current $238 pricing and that astronomical 97x PER, as their projected earnings per share of $2.51 in 2026 scales exponentially to match the price. The base case, which represents the most statistically probable future based on current cooling momentum data, assumes Credo maintains steady, respectable revenue growth, but overall AI infrastructure spending naturally moderates as companies digest their recent hardware purchases. The market reaction here would be a slow, painful valuation multiple contraction. The stock price would steadily correct downwards toward the Portfolio Pulse fair value estimate of exactly $130 as the extreme growth premium is systematically priced out by institutional investors. Finally,
The bear case. The triggers for this pessimistic scenario are the materialization of the exact risks outlined in their 10K filing. If the generative AI commercial viability falters, perhaps triggered by the strict enforcement of the EU AI Act across global markets, or if the documented AI bubble officially pops, the reaction will be severe. The 97x PER premium would evaporate entirely. This would result in a massive, uncontrolled sell-off, fundamentally resetting the company's valuation to traditional hardware networking multiples, completely regardless of their pilot platform's technological superiority.
And that right there brilliantly illustrates the dangerous crossroads Credo technology is at right now. To sum this entire complex situation up in one line for everyone watching, price is what you pay. Value is what you get. That is a classic Warren Buffett quote, and it absolutely hits the nail on the head here. Right now, you are paying a massive premium for the current price of CRDO, and you are basically betting that the value you get in 2027 and 2028 actually materializes perfectly before the AI bubble pops. Analyst, thank you so much for stripping away the hype and bringing us the cold hard facts today. So, to our focused learners out there, with a 97x multiple relying entirely on absolutely flawless execution, are you willing to pay for perfection today, or are you waiting patiently on the sidelines for the bubble to burst? Let us know your thoughts in the comments below. Thank you for watching today's explainer. Your subscriptions, likes, and supportive comments are a huge encouragement for our video production. We will see you all next time.